And with that, I'm going to turn it over to Jessica, who's going to walk us through the latest round of PPP.
Awesome. Thank you so much, Eric. And thank you everyone for joining us this morning. Real quick, just to reiterate something Eric said, their newsletter has been amazing. So if you are not signed up for that, I highly encourage you to do so. They just provide such great information, and I've used it a lot with my own clients. So with that, let me get my presentation. Okay, perfect. Okay, so we are POLTO EPIC. These are the partners of the firm. We have spent a whole lot of time this last 10 months or so really working with a lot of clients on PPP, keeping up to date with it, doing our best. If I can help anyone at this point, I'm going to say, relax. You know, they have made this program so user-friendly, not user-friendly, but you know, so broad at this point that obtaining 100% forgiveness should be relatively easy. The exception would be if you're just not even open, if you're not even operating at this point. But if you are operating, then there should not be any challenges with that. Having gone through many forgiveness applications at this point, we're very confident in making that kind of statement. I have maybe 1 or 2 clients that are not maybe getting to 100% forgiveness, and that's because they're not able to operate at this point. So let's get right into it. As a kind of a quick note, last night SBA and Treasury did release the first round of IFRs, which gave us some additional information on what was passed. That was their deadline. The 10-day deadline was yesterday. So I did scan through that last night and feel pretty good about everything I've got in here. There were definitely some more unique situations that I didn't really spend a whole lot of time on, but they may apply to you. So again, like Eric said, if you have questions, feel free to email me and we can help you through those. But I'm going to go over kind of big picture on what came through on that act and just kind of give you a big update here. So first, everyone that seems, I'm pretty sure, is here to hear about how do we qualify for the round 2 of the PPP. So here's the quick qualifications on that. It is slightly less than what the original round was. You have to have 300 employees or less. The first round is 500. And the big one for this one is you do have to have a 25% reduction in your gross receipts for any quarter in 2020 compared to 2019. When you're looking at gross receipts, this did come through in the information last night. They're basically saying follow whatever your normal method is. So whether you are accrual or cash basis, that's the method you're going to use when doing this. And I would follow your tax returns because that is actually what they're asking to see. It's not required, but they reiterated it several times. That leads me to believe that's what they're encouraging people to use. And I'll get into that in a minute. This is any quarter, doesn't have to be the entire year. So for, I think, a lot of businesses, Q2 is probably going to be the key quarter if the rest of the year was probably around the same or, you know, maybe slightly lower, but not 25%, because we had the shutdown for at least, what, 6 weeks in Q2. And so many people are probably going to have those significantly reduced gross receipts. But again, it's accrual or cash based on what you normally use. You do not include any proceeds from the EIDL or a grant or the PPP, which is good. It appears to be based on a calendar quarter. So if you have some weird, you know, some off fiscal year, like a February year end or something, you're going to follow a quarter, but probably best to just use a calendar quarter. And as far as the documentation required on this, so if your loan that you're going to apply for is 150,000, more than 150,000, you do have to provide support for this. Like I mentioned, they're saying use your tax return. Well, the challenge with that is your 2019 tax return is probably done. 2020 very likely is not. You know, we certainly haven't started on any of those. So and their thought on that was if your entire year, so if you're a calendar-based year end, if your entire year of 2020 compared to 2019 had a decrease in gross receipts of 25%, then of course any quarter within it likely has one. If that works for you, great. banks are probably going to ask for it, but I've got to imagine there's a lot of companies that are not going to be able to do that, especially considering the urgency a lot of companies are feeling to get this in. So providing your 2020 tax return probably is not a feasible response. They did that also to kind of help for people who may not have financial statements. The best example to that being maybe a Schedule C, sole proprietor that doesn't maintain a QuickBooks file or something like that. Then you kind of do need to provide your tax return in order to support your gross receipts reduction. But anyone who's keeping financial statements should be able to produce a quarterly financial statement for both 2019 and 2020 and show that reduction. If you are not in business for all of 2019 or for any of 2019, if you're a new business, for example, there are special rules that are outlined to instruct you on how to do that analysis. I don't want to go into that here, but just be aware that those are in place for you. The other qualifying here is that you had to have already taken the first draw. So if you did not apply or were not maybe eligible at the time to apply for the PPP loan the first time around, you have to go for that one first at this point. And they have reopened that, and I'll go over that in a minute. But the thing here was they didn't want people going and getting the first draw and then immediately applying for the second one as well. So you had to have gotten the first draw and have used it or will use it all for qualifying expenses, meaning you will have achieved 100% forgiveness before you take the second draw. Being that we're in January and most covered periods for that first draw are done at this point, you should know whether or not you have achieved 100% forgiveness, and then that would tell you if you're eligible for the second draw. All right, so the calculation for the second draw is essentially the same as the first one. You're going to use 2.5 times your average monthly payroll costs. You can use 2019 payroll or the previous 12 months prior to your application. So for existing companies, I would bet most are going to use 2019. And if that's what you use for the first time around, simple, it's the same number, it's the exact same loan amount. If you maybe are a new business and you didn't form until later in 2019 or even beginning of 2020, then you would need to use the last 12 months. Using calendar year 2020 is probably the easiest method there, but technically you can use the 12 months prior. So if you don't apply for this until beginning of February, for example, then you could use February 2019 through January 2020, February 2020 through January of 2021. That is a 12-month period. The exception here is for the hospitality industry. They have been, we know this very well here in San Diego, been very hardly hit here, or hit very hard here. So restaurants, hotels, anyone with this NAIC code of the 72, it's this range starts with 72, they actually get 3.5 times their average monthly payroll. So they're really trying to help this hospitality industry. If you're uncertain as to whether or not you fit in that, look at your tax return, or obviously talk to a consultant on that. When you're looking at the payroll you use, honestly, use whichever's better. They did not say what you have to. It's just use whichever is better for you. The change that they kind of made, and this is really minor, but I'll bring it up anyway, is that the covered period. Originally the loans were an 8-week covered period. And then they extended it to 24 weeks. Well, I can tell you in practice, and especially in ours, if a client finished it at 11 weeks, we said stop at 11 weeks and submit it. And because that was very widely used, they made kind of I guess they kind of codified that. So basically you can use any covered period between 8 and 24 weeks. So whatever works for your business. Reason being that if you wait to all the way to the 24-week period, and maybe you had a reduction in FTEs or something like that, you might get a reduction in your loan forgiveness that isn't favorable. So again, they're really trying to make this as easy as possible to get 100% forgiveness. The second draw loans, or actually all of these loans, are available through March 31st. So unless they extend it again, that is the cutoff. There definitely is some concern as to whether or not this money is going to run out quickly. Originally, I wasn't as concerned because of the 25% reduction test, but the more I thought about it, the more I think a lot of businesses still are going to qualify for that. Even if you kind of bounce back, if you just have to have one quarter, I'm going to use Q2 again in 2020, I think it's going to be really easy to qualify for this. So I would kind of encourage you to get on it and start moving on this. Loans are not, the SBA has not opened the application for this yet. We don't have the application and they're not accepting them. But I know a lot of banks are already receiving, bringing in information, getting it into their system, and just getting everything ready as much as they can. Now, like I mentioned, they did open up the round one, we'll call it the draw one loan as well, because they expanded it. There were some entities that were not eligible the first time around, one of the most notable being 501c6 organizations. And so their qualifiers are a little bit different, 300 or less employees, whereas it's 500 or less for most of the other industries. Also, they cannot be heavily engaged in lobbying activities. There's very specific restrictions on that. So if you are a 501c6 organization, do look at those qualifiers, but I would imagine, especially the local ones here in San Diego, probably qualify. But if you just didn't get around to it, you weren't able to, whatever it may be, and you did not get that first draw, it is open. And again, you do have to do that one before you can get the second. So look at that. And what's, I think one thing to note here is they have slightly different qualifiers. So I just talked to you about the second draw, which, the biggest difference being that 25% reduction test. That does not apply to the first draw, but the first draw had that requirement that you had to be negatively impacted by COVID. I was in a CE class the other day and they gave a really incredible example on this that I thought I'd share. So we know golf courses, they were shut down for about 6 weeks or so, and then they reopened. And industry-wide, golf courses are seeing a 70% increase in their business in 2020. So it'd be really difficult to say that you've been negatively impacted by COVID using hindsight at this point. Whereas when you applied for the loan in March, we didn't know. The world was falling down and this was, everyone was going for it because there was just so much uncertainty. But I think at this point, we cannot use that same logic, or at least it's gonna be very difficult to do so. So if we use the golf course example, if they didn't apply for the loan the first time around, and now they're looking at it and they're saying, well, it's open up again, I should apply, they might not be eligible for either, because you have to do the first draw first. And if you've not been negatively impacted, then you don't qualify, and you can't do the second one, even though your Q2 revenues most certainly declined by 25%, they can't do the second draw because they didn't do the first draw. So kind of be aware of that if you fit in that kind of unique situation. I thought that was a great example, so I wanted to share that. All right, so there are a few things to be aware of as far as who is not eligible for the second round. So if this is same for the first draw, second draw, if you were not in operations as of February 15th, 2020, you are not eligible for this loan, either of them. For the second draw, entities that are receiving what they've called the shuttered venue operator grants, you cannot get the second draw because there's a very special grant program that they've developed. And this is the easiest example for this is theaters, movie theaters kind of fall under this. So if you are an entity that falls under that grant program, you're going to go for that grant program, not the PPP. Publicly traded businesses are not eligible. Lobbying organizations are not eligible. If you are an entity that has an affiliation, which is defined as an equity interest, which is not just ownership, so be careful, with any sort of entity or persons of the People's Republic of China, then you're not eligible. So the easy example would be if you have an owner who's a 20% or more owner from China is not eligible, but also someone who holds a convertible debt is going to be the same thing. So look at that. If you're just working with vendors or distributors or something like that, which lots of businesses do, that does not disqualify you. This has to do with some sort of equity interest, okay? There are also a list of other entity types that are not, sorry, industry types that are not eligible. Gambling being one of them, and I bring that up because we actually deal with a lot of casinos, but there's a list of them. So casinos were eligible for the first round, not for the second. All right, so loan forgiveness looks very similar. It's actually the same for both loans now. And so even the original loans, these changes apply to those if you have not yet applied for forgiveness. So the first that we kind of should all know pretty well at this point, payroll, rent, utilities, mortgage interest, all of that's still there, but they've added additional expenses. You still have to keep the 60-40. So 60% has to be at least, you have to at least use 60% on payroll. 40% can be used on all of these other things. So the PPE and other costs that comply with COVID-19 health and safety guidelines, all of that cost could be covered by the loan. Certain supplier costs and operational expenditures. So I kind of explained them here. The IFR last night did go into those in further detail. I didn't want to spend time on that right now. Property damage costs. So any sort, if you had, from the riots or things like that in 2020, any impact from that, that is not covered by insurance, any costs that could be covered by the loan. One thing to note, and I will kind of, I've said this with all of our clients and I'll say it with all of you, I highly encourage you to do as much forgiveness with your payroll as possible. Honestly, it just makes your life simpler, especially if you're using a payroll provider, which I always recommend as well. They've got some really great reporting that makes your life pretty simple. And if you're going to try to cover that other 40% with all these other expenses, that's a lot of documentation on your end. So I would only go to those other expenses if you need to. If you've really reduced your operations and you're barely getting to the 60% payroll, then you can go to these other things. And if you want more information on the supplier costs and operation expenditures beyond what I've listed here, feel free to shoot me an email and I can send you the information. And like I said, this does apply to both the original loans, as long as you've not yet applied for forgiveness, and any new loans. They've also finally given us a simplified forgiveness form. They haven't released the form yet, but they've been instructed to do so. For loans that are $150,000 or less, it is supposed to be a one-pager. It needs to, you're going to provide the number of employees that you've retained, your estimated amount spent on payroll, which still has to meet that 60% test, by the way. So all of the rules still apply to you. It's just what you're going to give the bank and SBA is significantly less. And then you do need to still retain all your records. So you're going to retain your records for 4 years for all employment related expenses, and then 3 years for everything else. And for the second draw, you will have to provide documentation that substantiate your loss in revenue. If your loan that you're going for is under that $150,000, you're not going to need to provide that to the bank right away when you're doing your application, but you will have to give them that support before you apply for forgiveness. So one way or another, you're going to have to get that to them. All right. So timing expectations. So last night, we did get the first round of guidance that we were expecting. We suspect that SBA will start receiving applications next week sometime. So what you're going to be doing right now is figuring out who you're going to do this loan with. I would encourage you to go to your original lender first. Is probably easiest, in particular with the documentation. One thing I did read last night was that if you use the same lender, and if you're using the same payroll to support your loan amount, so if you're using 2019, for example, payroll information, you don't need to resubmit that. They already have it. They've already reviewed and verified it. So it may make your life simpler if you've kind of got all those things in place and if your lender is ready to go. I have heard though already, there are some lenders that are not quite there. I think some might be having some financial difficulties. We had one client, for example, who said their lender was requiring them to submit their loan application, their forgiveness application before they apply for the second round. That's nowhere in the requirements. from the act or from SBA. So that's the bank saying that. My suspicion is that the bank needs that loan paid off before they can, or at least they need to know they're going to get it paid back by the SBA, because the banks, you have to remember, are the ones who are fronting all this cash. SBA is not paying them until you get the forgiveness application in. So the banks are on the hook for a ton of money right now with very low interest coming in for it. So if they are financially struggling because of this, they might be making that sort of requirement. And if that's a challenge for you for whatever reason, then you may want to be looking for an alternative lender. What I would say there is there's plenty of options. So contact us. We have been partnering with different lenders to service our clients in our community. So if you have any concerns about one, your bank being able to respond, you know, we saw that first time around that the banks were just so, especially the larger ones who have a very large client base, they had a really hard time getting through those applications on a timely basis. And there were some other local banks that really did a phenomenal job servicing and getting those turned around in amazing time. So don't feel like you're stuck with your original lender. There are plenty of options at this point, and we are happy to help you with that. Let's make sure I got everything. So definitely start gathering your data now. You know, get everything together. A lot of banks are accepting information and kind of prepping for what we expect to get from SBA, getting into the portals, because the portals are all set up. This is a very different round than, you know, when we were back in March, because there were so many questions still in March. Everything was being developed. Everything's very well developed at this point. The platforms are ready to go. As soon as they get information from SBA, they're updating them and they're on it. So I would not hesitate at this point, especially if you have a very high need for this second round. All right. So a few other notes I wanted to touch on are a little bit tax related. One of the best things we heard right before year end was that the PPP expenses are now deductible. This is for federal purposes only. So to give you a little history on that, the original CARES Act that provided the original PPP loan said that the loan proceeds that were forgiven would not be taxable cancellation of debt income. Then the IRS reminded everyone that when you have tax-free income, any expenses related to that are not deductible. So then we've been, you know, we were in all of 2020 kind of planning around the fact that, shoot, it's still pretty much taxable. California did kind of conform with that. So originally California was in a position that the cancellation of debt income would be income. And then they said, okay, well, we'll just follow federal. So it's not income, but you can't take the deductions, which we all know is still the same thing from a tax standpoint. So now, because they made that very specific connection to that previous federal law, California does not conform. And in the industry, there's not a lot of optimism that it will conform, because California is in a whole lot of debt right now. They need the revenue, they need the tax dollars. So I would not hold my breath for it. If we start hearing chatter of that possibly coming around, what you may want to do is extend your 2020 tax returns and don't just wait until the fall and see if California does come around. You would want to pay your estimates at that point, pay any taxes that might be due on it, but you don't certainly want to have to go back and amend. So that's the recommendation we're giving our clients. But the good news here is that for federal purposes, you are not paying federal taxes on this loan that is being forgiven. And that is very amazing. The other big one was this, if you received an EIDL advance. So many people went and got that $10,000 grant that even if you didn't get the loan, you could get this advance and it would be forgivable, but then it was being deducted off your forgiveness. They have reversed that as well. And now that is fully forgiven and is not reducing the loan forgiveness. So anyone who previously had their loan already forgiven, but still had that $10,000 left, that will be fixed and that will go away as well. And then another side note, not tax, but just as an SBA matter, they have extended the subsidy of the SBA 7A loans. And this is where if you had a qualifying loan, the SBA was actually making the payments for you. So that will start up again in February for 3 months. It's capped at $9,000 a month. Certain underserved businesses are going to get 5 months. And the treatment here is consistent with PPP, meaning it's not going to result in a taxable income. You're not going to have to pay tax on that. So, again, California doesn't conform, but at least you're getting the federal benefit. Another big one has to do with this employee retention credit. So originally this credit also came out in 2020. And if you had received a PPP loan, you could not also take this credit. But now they've said you can. So, and they've extended it past 2020. So you kind of see here a comparison. The credit was 50% of wages. Now it's increased to 70%. And this is per employee that you retain. There are qualifiers. You have to have had a decrease in gross receipts reduction test. It was 50%. Now it's 20% for 2021 credits. Obviously much easier to qualify for at 20% versus 50%. And they have expanded to more employers. So previously it was only for employers with 100 or less employees, and now it's up to 500. And then the maximum credit was 10,000 per employee per year, and now it's 10,000 per quarter. So definitely something to look at. You would work with this through your payroll company and get this credit through your payroll taxes. But certainly spend some time on that as well. And then the paid sick and family leave. This was the one where if you're a smaller employer, you are required to pay your employees for the, if they get sick from COVID, or if they're stuck home with their kids and can't work and because their kids are out of school, you would have to pay them, and then you got a credit back on your payroll taxes. So essentially the government was paying for it. So that ended 12/31/20, but you as an employer can choose to extend it through March of this year and still get that credit. There are caps on it, so be aware of those caps. But it is an option for you. They're not mandating it like it was, but you can certainly extend it if you want to. All right, so I kind of did go through that quickly because I thought we'd probably have a lot of questions. Here is our website. We have put out a whole lot of resources this year, past webinars, all of that. If you have any questions, you can go there. Here's my email address as well. Email is the best way to get a hold of me. As you can see, I am working from home. So feel free to shoot me your emails, but we will kick it back over to Eric and let him throw out some questions.
Sounds good, Jessica. Thank you so much for that overview. And again, a couple people ask in chat, so I just want to let everybody know, when we finish up this webinar, we'll be converting it into a YouTube and getting out the link. It'll stay on our website for a period of time as well. So all the registrants will get that email coming out a little bit, probably just after lunch today, depending upon how long it takes to process the YouTube video. So Jessica, one question that we've had, kind of a number of times, and I know that you've provided guidance in the past on it. Let's talk a little bit about 1099 employees, or 1099 workers rather. Let's not call them employees, but 1099 contractors that somebody has working on site. How is that, in a variety of ways, both in terms of qualifying and then in terms of the loan amount, how do we treat 1099 workers?
So 1099 workers do not qualify. This is purely based on W-2 workers. So they on their own would actually go and apply for a PPP loan. As a side note, Schedule C businesses, these self-employed individuals or sole proprietors, I should say, they've got the best deal out of all of this. So they don't have to deal with as much limitations as everyone else. So, but yes, they have to apply on their own.
Okay, great. Thank you so much for that. And then just to qualify, I think maybe it was too fast when we went through it. Is it based upon the government fiscal year or the calendar fiscal year? Explain some of the issues about what year we're looking at.
With regards to the second fraud.
Yeah, the question in the Q&A was, you said the program is based upon the government fiscal year, which is, October 1 to September 30th. I thought it was based upon a calendar year, January 1st to December 31st, or January 1 to December 31st.
So
I don't think, I don't think
yeah.
there's anything that's involved with the government fiscal year, is there?
No. So if you're looking at the 25% reduction test, the recommendation from SBA was to provide your 2019 tax return compared to your 2020 tax return to look at the gross receipts test. But otherwise, the requirement, because that's not the technical requirement, that was just a recommendation they gave. The requirement is to look at your quarterly revenues so let's just use Q2. If you're looking at 2020 Q2 would be April through June. And that was when many businesses, especially here in San Diego, were really quite shut down. So that is likely the easiest quarter to look at for meeting the revenue reduction. You would compare that 2020 Q2 to your 2019 Q2 revenues and see if you have that reduction. You can use any quarter. I'm just using Q2.
No problem. All right, great. A question here, especially now that we've had this in the second, the second wave or the second draw. Has Treasury or SBA provided any information about how or in what ways they're are people self-certifying that they're in a particular NAICS code to qualify for the 3.5 versus 2.5, that are in the lodging and hospitality industry, or how are they dealing with it? The question in chat is, can you change your NAICS code prior to applying? We're in NAICS code 53 at the moment, but operating a hotel, which we built before that. So, we all know that NAICS codes are a little bit, so how is Treasury treating that? Do we know yet?
That may have been in here. I may have, I mean, there was a lot of pages, so I scanned through it quickly.
So that sounds like a great question to reach out to POLTO if you got that kind of particular situation of being kind of at the borderline of where you fit in terms of the hospitality industry.
I mean, my gut is going to say they're going to ask for your tax return. But yeah, well.
Yeah, makes sense because you have to put that down. Any from your clients that you're working with, any feeling for how long it's taken for banks to process the forgiveness part of it for the draw one loans to be forgiven?
So the banks themselves have definitely varied. I mean, gosh, I just heard that there were still some banks, and I can't imagine this, so it might be old news, but there were still some banks that didn't have the forgiveness application open. I would say some of those smaller banks, really did a great job. And I think it's just because they have less volume, right? And they got through them really quickly and submitted them to SBA. SBA has taken about 60 days. They're about 2 to 3 months to get the forgiveness. But I think once you get your banks sign off on it, you should have pretty good confidence at that point.
Perfect. This question in Q&A, I believe, the answer is yes. The person asked the question, on our P&L, we suffered a sales loss over quarter from January through March 2019 to versus the same quarter, Q1 2020, of 39%. That would seem to meet the qualification, assuming that there aren't any other revenues coming in to create their gross receipts, correct?
Right. So I can talk to that real quick. So because I do think that's important. So gross receipts is defined to include all revenue, whatever form received or accrued. So that's what I said in accordance to how you normally count for things. Includes sales of products and services, interest, dividends, rents, royalties, fees, or commissions, reduced by any returns or allowances. You do not include sales tax. So if you're a retailer or something like that, don't include something that you're collecting and remitting to, another agency. And if you have intercompany type transactions, you you don't include that. Or if you're like a good example is a travel agent. If you're collecting monies for, you know, like a travel thing, and then it's gonna, most of that's going somewhere else, you're only gonna count your fee. So that's what you're looking at.
Great. Jamie asked, this is an easy question because this is to me. Jamie Johnson asked, can she share this webinar with her members? Absolutely. Just give us credit and think good thoughts about SDNEDC as you do so. And then a question, and I think the answer is no, but Jessica, let's see if Treasury's given any other indication. If the company isn't able to show a revenue reduction of 25% between any of the quarters, in other words, that they didn't suffer at least a 25% decline, are they automatically disqualified from applying, or is there another way to show impacts that would let them qualify to apply?
Yeah, there's no other way. It is just revenue. So, you know, even if you still have really great profits, you know, and you still have that revenue decline, you would qualify. But if it was the opposite, you know, your net income tanked, but you still didn't hit that 25%, it wouldn't qualify.
Oh, and then this was a question, and I can't remember your answer. So just to clarify or to restate, do they need to be forgiven for their first PPP before they can apply to the second? How does that work, the timing on the draws?
Yeah, you do not have to have forgiveness. You don't even have to have applied for forgiveness before you can apply for the second draw. You are just going to certify that you have used your first loan and you qualify for 100% forgiveness. But if you're going to prioritize one over the other, you're probably going to prioritize applying for the second loan and then go back and figure out, you know, finish your documentation for your forgiveness application.
And this one seems a good one just for lots of folks on the webinar. Any guidance on how the maximum number of employees is calculated? Is that an FTE calculation? Just a person named on the payroll? How do we calculate that 300 number?
That's a very good question that I had myself and was not answered. So I'm going to take a professional opinion here and say, I think it's employee count, it's head count, not FTE, because they've been very specific in referencing FTEs in the guidance when that is a way to count for it. So since it does not reference that, it must be employee head count. And I'm also going to say the easiest way for, I mean, it's not the best way to do it, but on your 941s, you have to provide for each, that's your quarterly payroll reports that you do have to submit as support, right? It actually says how many employees you have from month to month. So if that's going over 300, for example, you might have to explain why you're applying. You know, like maybe you had a couple drop off and you replaced them or something like that. But to me, if I were a banker, that's what I'd be looking at.
Okay, good. Let's see. I want to go through and just make sure we answer any of the ones that are applicable.
I just saw a question come through that was I think I might have missed. So the PPP, the round 2 is capped at $2 million. I may have missed that on my presentation. So thank you, Nicole. I saw that. So the first round was capped at $10 million per loan. This one's capped at $2 million per loan.
Okay. I believe Thomas York asked, and I think the answer is sadly no, which is if you're a supplier to the hospitality industry, do you qualify for the 3.5% or the 3.5x versus the 2.5x? And I think the answer is that you don't qualify.
I don't see a way around that either, because it's very specific to that code, and a supplier would not fit there.
Yeah. Let's see. And then I think the rest, and if we didn't get to your question, I apologize. Again, some of these things get really quite specific into your business operations and probably even need a greater amount of detail in the explanation in the questions that you set up. So again, I'm going to encourage some of you, if I didn't get to your questions, to zap an email to Jessica and then see what she can answer quickly, or if it makes sense for you to engage in that effort with POLTO to get some really specific fine tuning on that. And then, a good question from my good friend Dale, who's our good friend too, that does food bank stuff with us. Is there any preference for 501c6s, or are they just in the mix with everybody else that we just need to get hopping on it?
I haven't seen one. The money set aside for round 1 draws is much smaller than the money set aside for the round 2 draws. And there are some set asides for certain industries, which I don't know off the top of my head. But I haven't seen anything specific to C6s.
Okay. Yeah. I know that, if anybody else is a C6 on the line, we've got everything that we're working through, and I'm talking to my banker today. So, just to kind of get everything set up and ready then. This is a good one for everybody. Just and I don't know if there's any rules here. Can you ask for more money in this draw than you did in the first round, or how do these interact?
That's a good question. So the first time around, there were a lot of questions and a lot of things that were very unclear, and some companies, excuse me, water went down the wrong side. Some companies didn't get as much money as they would have qualified had they have known the full rules. So 2 things. You can actually go back for especially if you're above 300 employees maybe, but below the 500, you can go back and get the additional monies that you should have gotten for round 1. But for round 2, it's still the same test, but now we just know a lot more about it. So for example, payroll costs include not just wages, but also benefits. So if you pay retirement and health insurance, you can include that in your cost for that 2.5 times average monthly cost, right? Whereas before, if you just use wages, you probably got a lesser amount. So you could bump it up for that. Additionally, if you are a partnership structure, there is a lot of uncertainty as how to deal with partners who don't get W-2s. But now we know that compensation can be included. So you could get additional monies just from understanding that we have more understanding with it. So if you fall under some of those, then you would certainly want to talk to your advisor and get some advice.
Okay, great. And let's see. And then I thought we had one question. Let's see, where was that one? So somebody had a question which I thought was useful, which is, and maybe a more general conversation about ownership structure. So a person asked about their clients who were considering moving and changing their business structure into an S corp, and should they stay in their sole proprietorship for 2021? Does it make sense given the PPP to stay in that position, or given the variance, and if there were smart business reasons otherwise to move into S corp, would you suggest that's the process, that's the pathway to take?
That's an interesting question. I would so if your federal ID number is staying the same, I don't know what that does, because it's tied to your ID number. There are certain rules that came out with regards to like if a company merges with someone, or things like that. So I think we would want to look at those rules to see if it addresses that.
Okay. And then this is a good question. I think people sort of think back, because I think everybody sort of thinks back. Okay, we were in the middle of the pandemic. So if people are taking this draw and then they're looking for forgiveness afterwards, and these are sort of new expenses or expenses that they're incurring in, say, quarter 4 of 2020 or quarter 1 of 2022, or excuse me, 2021. So, during the height of the pandemic or the first shutdown, they didn't have an office. Now they do, right? And so now they do have a lease expense. How should they be thinking about that?
Yeah, so for a lot of the expenses, the target date or the key date is still that 2/15/2020. So if you didn't have a lease in place at 2/15/2020, then any lease expense after that does not qualify. Same actually goes for some of those costs that I kind of, scanned over or quickly went over, the supplier costs and things like that. The IFR does specify that these need to be contracts that were in place at 215. So I don't know how helpful that's going to be to the second round, but maybe to people still working through the first round that does. And that's, that's pretty much true for anything. So other than employees, you can hire employees after the fact, but for a lot of those others, your mortgage, your utilities, your rent, all of those had to have been contracts and services in place at 2/15/2020.
Got it. So kind of the idea, or at the broadest point, or at the 50,000 foot level, the idea really is to try and think about this loan as a way, or this forgiveness program, this forgivable loan, as a way to cover fixed expenses that you had entered into or engaged in, and then a global pandemic hit you. And now we're trying to help you sort of survive and get through that.
Yeah, that's a great way of putting it.
Perfect. Okay, great. Before we close, I want to just make sure any other questions that people might have that we haven't answered, you can put them in the Q&A and we can get to them a little bit. We said we would go to 9:30, but we hope that this has been helpful. So people have that. Again, Jessica, I want to thank you again for doing this and for the service to the North County business community by getting this information out and getting people structured and thinking about it. The other thing I would say to all the participants on the webinar is that in addition to the PPP program, the state of California has stood up a grant program. Our local Small Business Development Center has been trained up on helping people think through and applying for that. The deadline is next week. So good to jump on it. They have some recorded webinars that are there. It's a competitive program, so it's not like first come, first serve. The state is doling out though $500 million, so it makes sense to get into the mix. The slides will be available. And then one last thing, and so I just want to make sure that people understand that. So and again, you mentioned it again, but so correct me if I'm wrong, Jessica, because I want to ask you to say it again. 1099 workers, they're not your employees, they're your contractors. They should be applying themselves as independent contractors, independent businesses for this program. The expenses that you incurred and in retaining their services are not qualified for those payroll expenses that they have, but they as individuals negatively impacted because you didn't continue to contract with them or you cut back on your contracted services with them, they can apply for a PPP and get some relief through this program. Is that a layman's non-CPA way of saying it?
Yeah. Yep. Well said.
Perfect. All right, great. So again, I know that, we live in a weird world of independent contractors and kind of continue to do that. But I think that that's the right way to think through. Again, thanks everybody for registering. Jessica, thank you. Everything will be out to folks here in a little bit. And again, if we can be of service to anybody that's here on this webinar, zap us an email and let us know how we can help and resources to help you get through this. And we can, not to quote too much, but we can build back better as a North County economy.
All right. Thank you.
Great. Thanks, Jessica.